New York City, October 24, 1929, Black Thursday. The New York Stock Exchange is in free fall. Crowds are gathering outside the building on Broad Street. Men in suits are weeping openly on the sidewalk. Fortunes built over decades are evaporating in hours. Brokers are throwing themselves from windows. The newspapers are calling it the end of American prosperity. 2 blocks away, in a private office on Wall Street, Andrew Mellon is on the telephone. He is not selling. He is buying. Quietly, methodically, without panic and without hesitation, he is accumulating assets that the terrified crowd is desperate to unload at any price. Real estate, gold holdings, stakes in essential businesses. Within 3 years, while 25% of Americans are unemployed and the economy has contracted by 46%, Mellon's core holdings have not only survived, several have appreciated. This is not a story about genius. It is not a story about privilege, though privilege was present. It is a story about pattern recognition. Mellon had studied what wealthy men did during the Panic of 1907. He had read what the Rothschilds did during the Napoleonic Wars. He understood something that the crowd on Broad Street did not: that economic collapses, regardless of their cause, their geography, or their era, always produce the same result for the same 5 categories of assets. And the people who understood that forensic record were never the ones weeping on the sidewalk. This pattern has repeated without exception across every major economic collapse of the last 5 centuries. Weimar Germany, the Great Depression, Argentina 2001, Zimbabwe 2008, Lebanon 2019, Venezuela today. The assets that preserved and grew wealth during each of those collapses are identical. The names of the people who accumulated them are different. The forensic principle behind why those assets survived is always the same. This is not financial advice. This is an economic autopsy. We are reading the record of what actually happened. 5 assets, 5 centuries of evidence. The wealthy were never smarter than the crowd. They were simply reading a document that most people never knew existed. The first asset is the oldest store of value in recorded human history: gold and silver. And before you dismiss this as obvious, understand what the forensic record actually shows, because the numbers are not what most people expect. Frankfurt, Germany, January 1922. The German mark is trading at approximately 190 to the US dollar. Uncomfortable but manageable. A middle-class German family holds their savings in marks, in government bonds, in the institutional currency of the most industrially advanced nation in Europe. A wealthy Frankfurt banker named Heinrich Mannheimer is doing something different. He is converting mark holdings into physical gold and Swiss francs at a rate that his colleagues consider eccentric and his family considers alarming. By November 1923, the mark has reached 4.2 trillion to the dollar. The middle-class family's life savings, their bonds, their pension, everything denominated in marks is worth less than the paper it is printed on. Mannheimer's gold holdings, measured in any stable currency, have not lost a single unit of real purchasing power. The asset did not appreciate dramatically. It simply refused to participate in the destruction. This is the forensic principle behind gold and silver during collapse. They are not growth assets. They are refusal assets. They refuse to be inflated away. They refuse to be frozen by banking systems. They refuse to be devalued by government decree. Their value is not derived from institutional promise. It is derived from 5,000 years of human consensus that predates every government that has ever tried to replace them. The Rothschild family understood this with a precision that borders on clinical. during the Napoleonic Wars between 1803 and 1815, as European currencies were destabilized by the cost of continental warfare, Nathan Rothschild in London was operating a gold arbitrage network across 5 countries simultaneously. He was not speculating on gold prices. He was using gold as the one asset that all parties in a collapsing monetary environment would accept as real payment. The family's wealth, already substantial, compounded dramatically during a period that financially destroyed most of the European merchant class. Zimbabwe between 2007 and 2009 produced the most extreme modern documentation of this principle. The Zimbabwe dollar lost 99.999999% of its value. Citizens who held physical gold, even in small quantities, even a few grams purchased before the hyperinflation accelerated, preserved purchasing power that holders of bank deposits lost entirely. The World Bank's post-crisis analysis of Zimbabwe noted that gold possession was the single most reliable predictor of household economic survival during the peak collapse period. Lebanon between 2019 and 2023 confirmed it again. The Lebanese pound lost 98% of its value against the dollar. Lebanese families who held gold jewelry, a cultural tradition dismissed as sentiment by Western economists, discovered that their grandmothers had been practicing sound monetary policy. Physical gold held outside the banking system could not be frozen, could not be haircut, could not be inflated away. It simply retained its value, while everything denominated in pounds evaporated. The pattern is the same, every time, in every currency, on every continent. Gold and silver do not make you rich during a collapse. They ensure that the wealth you had before the collapse survives it. That distinction is everything. The wealthy already knew this. Now you know why. The second asset requires more nuance to understand correctly, because the common version of this principle is wrong in a way that costs people everything at exactly the wrong moment. Buenos Aires, Argentina, January 2002. The peso has just been unpegged from the dollar and has lost 40% of its value in 72 hours. The formal banking system has frozen deposits. Middle-class Argentines who held their wealth in peso-denominated savings accounts are watching it evaporate in real time. Property values denominated in pesos are collapsing in real time. But something specific is happening in the Palermo and Recoleta neighborhoods of Buenos Aires that the aggregate data does not capture. Wealthy Argentine families who own apartment buildings and commercial properties that generate dollar-denominated rents are experiencing something entirely different. Their properties, valued in pesos, appear to be losing value on paper, but their income, collected in dollars from tenants who need to live and do business regardless of the currency crisis, is holding. In dollar terms, their real income is not collapsing. It is stable. And in some cases, because peso construction costs have fallen dramatically, they are building new properties at a fraction of the previous cost. This is the forensic principle behind income-producing real estate during collapse. The key word is income-producing, not speculative development, not vacant land, not leveraged flips. Income-producing property, the kind where people pay you monthly to live or operate a business, addresses a need that economic crises do not eliminate. People still need shelter. Businesses still need space. And the landlord who owns that space collects rent in whatever currency the local economy is actually using, not the official currency that is dying. The NERB working papers on the Argentine crisis document this pattern with precision. Rental income in dollar terms from Buenos Aires residential property declined approximately 15% between 2001 and 2003. Peso savings accounts lost 67% of their dollar value in the same period. The real estate was not a perfect store of value. It was dramatically superior to every alternative available to Argentine savers at that moment. John D. Rockefeller during the Great Depression demonstrated the same principle at scale. While bank stocks were losing 90% of their value and industrial companies were going bankrupt at a rate of thousands per month, Rockefeller was quietly accumulating income-producing properties in New York City. He began construction of Rockefeller Center in 1930 at the absolute nadir of American economic confidence, using Depression-era construction costs that were a fraction of what they had been in 1928. The properties generated rental income throughout the Depression. They appreciated dramatically when the economy recovered. He was not predicting recovery. He was reading the forensic record of what income-producing assets do during collapse. The critical qualifier that the forensic record makes clear is leverage. Income-producing real estate purchased with borrowed money during a collapse becomes a liability, not an asset, if the income stream is interrupted.